Okay, so here we go with the second video about the 2010 higher level cash budget. In the first one, we went through all of the cash sales, credit sales. We talked about our purchases, 1 month and 2 months on credit respectively. Talked about the wages and the variable overheads. So now we're on to the fixed overhead. Paragraph 4 of your question says that fixed overheads, including depreciation, are 45,000 euro per month. There's your 45,000 per month. But why does it say including depreciation? And it says they're payable as incurred. Well, depreciation, of course, is a non-cash expense. You don't have to pay anybody depreciation. You don't have to write a check for it at the end of the month or that. So therefore, we're doing a cash budget. So therefore, we must take out our depreciation because it is not a cash expense, whereas the rest of these things are. So we're going to remove that from the fixed overhead to get a true reflection of the fixed overheads we have to pay cash for. Now, how much is depreciation? Well, you need to read down to the capital costs underneath the second half of paragraph 4, basically, in your question, where it says, equipment will be purchased in July, costing 48,000 euro, and it will have a useful life of 5 years. Well, that means 48,000, a useful life means that at the end of the 5 years, it is useless, therefore has been fully depreciated. So that means if you divide that by 5, 48,000 divided by 5, that means it's going to depreciate by 9,600 every year. But of course, we would prefer to find out what it is per month. So if we divide that by 12, that's going to be 800 per month. So we can now say that the depreciation on our vehicle, or actually on our equipment, is 800 euro per month. We do not count that. So therefore, you take that out of the 45,000 figure. So actually, the fixed overheads every year are going to be 44,200. And that's every month as incurred. That might be insurance, might be rent, rates, things which are fixed and will not change from month to month. So that's how we get that 265,200. Now, now we're on to our equipment. The equipment itself, it says, was purchased in July. So therefore, you need to include that in July, 48,000. And of course, that will be included over here in the total volume. And then they do talk about that we have to pay a loan. Now, let's read that there. It says I'm reading the second last sentence of the whole question there. It says, to finance this purchase, a loan of 44,000 will be secured at 9% per annum. Interest is to be paid monthly, but the capital repayments will not commence until 2012 January. So therefore, we don't have to worry in this budget about the capital repayments and paying back the loan, but we do have to pay the interest. The loan is 44,000. Multiply that by 9%. And that's going to be 3,960 is our annual interest. But of course, we are looking here all the time at monthly numbers. So we divide that by 12, and that's 330 per month. So therefore, we can put in 330 euro in each of these months. And that was purchased in July, and the loan was borrowed in July. So therefore, we can start that interest here. And that's going to be across the whole board. Now, my Excel sheet has done some work here, which your calculator will have to do, which is adding up now. Let me just show you. We're adding up all of the payments to get 235,030, and all of the payments in August to get 285. 130, etc., etc. And then, of course, I showed you the process in the ordinary level questions. You take your payments, this 235, away from the 155 above to get quite a significant net cash outflow, or a deficit of cash of minus 79,230 in the first month of July. That would be normal enough for a company who is setting up, because they have setup costs at the beginning. And as we have seen, they're not collecting all of their money from their sales until 2 or 3 months in. So therefore, that's understandable. The net cash situation improves month on month to, it's a positive 1270. It is a positive 42,000, a positive 65, a positive 94,270, all the way up to here. We know how to do that. Now, here's one new part of this question. There was no opening cash because they had completely set up, but they did borrow money in July, and that goes in here as their bank loan. The opening cash is 0. We weren't told about that. So therefore, that means that their closing cash is actually minus 35,230. And then you bring that up here, and then that's minus 35,230. And then we're on a very familiar process here. This is going to be minus 33,960, minus 33,960. Then we're into positive territory. That's 8,410, 410, 73,680, 73,680. We start the month of November with. And in November, we have finished with 167,950. We move that 167,950 up to the opening cash of December, and then we're going to get 235,620 here. Of course, I omitted here. I should have put in the 44,000 from over here. I should have put that in the total column as well. And of course, the opening cash for the total column is 0 because it was 0 in July. And when you add those two together, you're going to get 235,620. And that matching amount there in the closing cash means that we've done our budget correctly. Now, then we can progress down to part B of the question, where it asks you to do a budgeted profit and loss account. I've left the numbers here, and I'm just going to show you where they come from individually. So we're going to do sales. Now, because we don't have opening stock and closing stock here, we're going to do cost of sales almost like a manufacturing account. You will see more of this when we do product costing, which is a topic we'll be doing after Easter. But you do your materials, your labor, your variable, and your fixed overheads to get your gross profit instead of opening stock, purchases, closing stock. And then to that, then you add on incomes like discount received, and you take away expenses such as depreciation, interest, or discount allowed. Let's go back and check out where you get all those numbers from. Now, the sales number is taken directly from the question. The horizontal addition of the sales numbers in the question 322,000, 3,220,000. Likewise, the purchases number here of 1,570 taken directly from the question. That's the purchase of materials, 1,570. And these next three, labor, variable overheads, and fixed overheads, they are all taken from the total column here. When they were added up, you have 240, 805, and 265, 200. So therefore, they were already added up for you, and you just had to translate them down into the cost of sales. You add up these four cost of sales to get your 280, 880, 200, which you take away from the sales to get your gross profit. All of those numbers straightforward enough. Here it gets a little bit trickier. The discount received is actually probably the trickiest part of this whole question. Discount received is the discount that we have received on things that we have bought. Now you need to refer back to your question to remember that we received 2% discount on half of all our purchases when we paid them 1 month after. Now, that is important because our total purchases are 1570 from the question. But because we receive discount 1 month after when we pay 1 month on credit, we need to take out the December purchases because of course that discount we will not receive until the following year in January when we pay for it. So when you take out that, that's going to give you, I think 122. Your calculator will tell you that. That figure then you multiply by 50% because you only get discount on half of your purchases, and then you also multiply by the rate of discount, which is multiplied by 2%. And when you do that there on your calculator, tricky enough little sum to get your head around, but when you do that there, you'll get your 12,200, and that is your discount received. I'm just going to recap that again. That is all of your purchases, take out the December ones because we won't receive that discount until next year. You multiply that by 50% because we only get discount on half of our purchases, and you multiply that by the rate of discount, which is 2%, and that is your total discount received. Depreciation of equipment. Well, earlier in the question, we learned that the depreciation was €800 per month, and of course, we're doing this for 6 months. So therefore, €800 per month by 6 months will give you that 4,800. Directly from here, I'm going to go back up to the question. You remember this €330 across the 6 months, giving you 1980? Well, there's the 1980 number here. And then finally, discount allowed, the last tricky bit here. Discount allowed is the discount that we have allowed our debtors. And if you refer back to the very top of the question, we have sales of 3,220, but of course we only allow discount on 40% of that because those are the people who pay immediately, and we give them 5% discount. So if you take your 3,220% and then you multiply by 5%, you will get 64,400. That's our expense called discount allowed. You add up these three expenses to get this, and then your net profit, well, that's the gross profit plus your income, take away your expenses, gives you your net profit. There is also a little bit of theory on this question about adverse variance. That will be in your theory handouts. But I'm going to wrap this at this stage. Thank you very much.